Hello and welcome to the Rising Tide market update for the March quarter of 2026. Over the next 5 minutes, I will walk you through some March quarter commentary and spend some time there as it was a volatile period for the stock market. Touch on the performance of the stock market, answer the question, what should I do? What does it all mean for me? And wrap up the conversation with a very quick look at the BlackRock Enhanced Strategic Portfolio product suite, something that is available to all Rising Tide clients. Now, the headline for the March quarter commentary is that geopolitical risk continues. In 2025, it was the trade war, that tariff war waged by the US. This year, it is the Middle East conflict with the US invading Iran. Now, that uncertainty has sent shockwaves through the global economy and stock markets, which has led the stock market to sell off during the quarter in the mid-single digit range. Now, on the ground, we are seeing higher oil prices and its effects. We are seeing supply shocks start to flow through, and that all culminates in inflation concerns here in the stock market. But what we do know is that the market has priced the known risk in. What we are seeing out there, what we are seeing on the news wires, is priced into assets and the stock market. We are actually seeing a strong rebound in the stock market as the news flow turns positive here in April. You can see that bottom dot point there post-March quarter. More locally, there was a rate hike in Australia as inflation remains stickier than the central bank would like. And more globally, there is a hawkish tilt with central banks as inflation more globally is hanging around a bit longer than we had hoped for. Under the hood in the stock market, moving aside from the Middle East conflict, there was a software sell-off in the USA. Last year, the narrative was AI and what can it do for me? This year, that has turned and the question is now, which companies is AI coming for? That has led to a market leadership broadening. So what we mean by that is that those tech companies have passed the torch to other industries and sectors in the stock market to lead it higher. Think defense companies, think banks, and think commodity companies led by oil companies. As I mentioned, a strong recovery in April is being seen as I record this commentary. Now, during the quarter, the S&P 500 was down 4.6%. That led the market lower based on or led by those tech companies. The European market down 3.8%. The FTSE 100 up 3.4%, led by non-tech companies, led by banks and commodity companies, and the ASX 200 down 1% right there in the middle. So diversification matters. This is why we like to be globally diversified across countries, sectors, and industries. The chart on your screen here is of the S&P 500 over the last 12 months. You can see the sell-off over to the right, but then also that really strong recovery that we have seen post-March quarter as news flow turns positive. Now, what should I do? What does this all mean for me? There is always a reason to sell in the stock market. It never feels comfortable when we see these headlines, but history has shown that these headlines come and go. However, the stock market will typically climb that wall of worry given the right time frame. So the chart here is from 2009 all the way to 2025. The stock market has been incredibly strong over the period, and that is as included periods like the trade war I mentioned, like the flash crash and taper tantrum, like the Russia invading Ukraine, like COVID, and all those other line items on the screen there. The stock market typically climbs a wall of worry, and we believe this period is no different, no matter how uncomfortable it feels. The chart on the right there, those bar charts highlight that even if we had invested at the peak of the market, held for the right time frame, you will still get strong returns. This table here, I want to focus here on that bottom line there. So this talks about the best days in the stock market have always followed the worst days. So over the last 20 years, the vast majority of the best days in the market have occurred within 1 month of the worst. What we are seeing right now is no different. We are seeing negative headlines and uncertainty. We are seeing the stock market pull back, and then we are seeing a strong recovery. What that means is that being invested and staying invested is more important than timing. No matter what anyone says, no one has that crystal ball. The key to achieving long-term success in the stock market is consistent investing and being invested and remaining invested. So had we invested $100,000 in the S&P 500 20 years ago, we would have 717,000. That is that red bar. Had we missed only 5 of the best days, we would only have 452,000. All the way to the right of the screen, had we missed the best 25, that is only 25 days out of 20 years, we would only have 158,000. So we do not know what tomorrow brings, but we do know that strong returns follow negative returns in the stock market, and they typically follow periods of uncertainty. So stay invested is the most important thing. What else should I do? Ensure your time frame of goals is up to date. Have a discussion with your advisor if you need. That gives us the clear mandate to help manage your risk, to make sure your risk profile and time frame is aligned with your investment profile. And of course, continue to invest. Continue a regular investment plan through ups and downs. However, these periods are uncomfortable, and if you do have any concerns, please reach out to your advisor. Now, wrapping up the conversation with a look at the BlackRock Enhanced Strategic Portfolio product suite. This is a globally diversified multi-asset portfolio with a range of risk levels to align with your individual risk profile. Now, here at Rising Tide, we are big believers in index investing. This is a market-aware index product which is dynamic, which is research-driven, which does trade and react to events like we are seeing. Now that results in top quartile performance, which I'm going to show on the next page, and most importantly, remains at a low cost. Please reach out if you would like any more information on any of those line items. What we're looking at here in this colorful chart is the performance of the BlackRock portfolio product suite. I'm going to have a look at the top line here, the all growth portfolio, which is a really common portfolio. Over the last 3 years, through up and down markets, it has returned 11.6%, outperforming its peer group median of 10.6%. This is what we mean by top quartile performance over multiple time frames and across all those asset classes. So thank you for your time. It looks like I've run a little bit over. If you have any questions, please send me a message or reach out to your advisor, and I look forward to catching up in 3 months' time. Thank you.